Value investing used to be popular. I remember 10 years ago, there was a lot of talk about value investing. My value investing blog was pretty popular. People liked to read what I said. But then value investing died. Over the last few years, I haven't been getting lots of love. Value investing has been considered, out of style, out of fashion, not cool. So is it dead? Will it ever die? That's what today's video is all about. If you're new to this channel, my name is Mariusz Konieczny. I run Microcap Explosions, a website dedicated for microcap stocks, hated and ignored by the investment community. I also wrote 10 books on investing, one of which is available for a free download at microcapexplosions.com. So make sure you get yourself a copy. About 10 years ago, value investing was hot. There was Bruce Berkowitz was named the manager of the decade, I believe, by Morningstar. Lots of value investing blogs were popping up. I was one of them. And this hasn't been the case over the last 5 years or so. Value investing has been considered something for the suckers. The most popular money managers were focused on the growth, disruption, anything that had nothing to do with value or intelligent investing. It was all about, short-term performance. So let's talk about whether value investing, because it seems like it's coming into fashion, because the growth investors are getting burned every day. They're licking their wounds. So there is more attention being paid to value. Maybe value investing is not dead. Well, I'm here to say that I don't think it can ever be dead, because you cannot say that intelligent investing is ever going to be dead. Let's go back to basics to think about what exactly is value investing and why it's never going to die. See, think about this. Let's think about businesses and how they form and how they become publicly traded companies. An entrepreneur has an idea or identifies a problem and develops a solution, whether it's software or a product, and he or she starts selling that product or service to the customers. As the business grows, revenues grow, hopefully they're getting closer to profitability. But usually, in order to propel the growth, because growth might require bigger facilities, money on marketing, the entrepreneur needs help. And in order to get that help, the traditional route is to get funding through venture capital. That funding is used to propel the business to the next level. But venture capitalists don't do this just out of good heart. They want to get a return on their money. So for them, the exit strategy is to take that business, take it public, and cash out their private investments and sell it to the public in the secondary market. Because while the company is in venture capital hands, it's in the private hands. They cannot really freely sell those shares or their ownership interest in those businesses. So once the businesses become public, they are freely traded among investors. But they have a particular ticker symbol assigned to them, and what is behind the ticker symbol is a business. And as the business grows bigger, as the business signs up more clients, becomes more profitable, the value of the business grows. And that's why over time, if your business makes more money, your company is going to be more valuable, and then the stock will trade at a higher price. It's no coincidence that Apple's stock went from a particular level to another level. Why did this happen? Well, because Apple made phones, computers, solved and satisfied its customers, made more revenues, generated more profits, and over time, the company became more valuable. This is never going to change. What is happening at the business level and how it will impact the value of the company in general, this will never change. We will never have a situation that the companies that perform poorly and lose customers, don't do well, will be increasing over time. They might, of course, increase in the stock from one week to another because of the flow of money. But over time, the value of the company will always be tied to the price of their stock. That's why in the long term, the stock market is a weighing machine, and in the short term, it is a voting machine. This is never going to change because the fundamentals of business will never change. It will, again, we will never have a situation where bad companies are going to be better than good companies. It's never going to happen. But what investors get confused in the short term, because they only look at one piece of information, which is the price. And they might look at somebody's performance over, quarters or even some years. And then they might say, well, this person is doing the right thing because the performance of their portfolio of the hedge fund is doing well. What's important is to realize is what's underlying that performance. Is that performance happening because the actual businesses are performing according to that performance? Or is the performance based on investors getting overexcited and overpaying for businesses without paying any attention to those businesses? Because if you have a stock that is worth $1, okay, and the stock price goes to $10 and people see that increase in the stock price, that has nothing to do with the performance of the business and has everything to do with hype or people getting overexcited or bubble blowing up. And now, if you purchase a stock for $10 that's worth $1, okay, and it comes down 50 cents, that's a completely different scenario that when you buy a stock for $10 and it's worth $20 and that stock goes from 10 to 5. It's a completely different scenario because if that stock goes from 10 to 5 and the value is 30, this stock becomes more appealing. It will attract more buyers because they are paying 5 and then they are getting 30 in value. But if you paid $10 for a stock and you didn't care at all about what the company was worth, and if it was worth only 10, if that stock goes to 50, if that stock goes from 10 to 5 and it's only worth 1, this is not going to entice anybody to buy it. It doesn't become any more appealing. It actually becomes less appealing because the people that were in this stock, they were only paying attention to the price. They weren't paying attention to the value. So they're going to panic and they're going to sell. And the stock might keep going down and down and down until it entices the true intelligent investors to say, okay, now it's the right time for me to pull the trigger. And it might be the stock has to go down to 10. This might not even be enough. It might have to go down to 5. Or, well, not 5 because it was 10 to 1. It might have to go down to 50 cents for value investors to step in and say, okay, I'm paying 50 cents and I'm getting $1 in value. Okay? So it's a completely different scenario where you are buying something undervalued or reasonably valued, and if it goes down, it becomes more undervalued, versus you're paying ridiculous price. It goes to a little bit less ridiculous price, and it has to go to even a little bit less ridiculous. It has to go through all these levels before it makes any sense to anybody else. And remember the rule from Warren Buffett. Rule number 1, never lose money. Rule number 2, don't forget rule number 1. This is what people completely misunderstand about value investing, because they think that when he says never lose money, it means that your stock should never go down in price. That's incorrect. Never lose money means never have permanent capital loss. So again, if you buy something that's worth 30 and you buy it for 10 and it goes to 5, you didn't lose any money as long as you correctly calculated the value, because you hold it long enough, eventually the stock will reflect the value of the underlying business. But if you buy something for $10 and it's worth 1, and then it goes to 5, you totally lose money, because how is that stock going to go back to 10? If it's still ridiculously priced, you're hoping that it's going to get double ridiculously priced? Well, good luck to you with that. In the short term, when you are a value investor, you might look dumb. You might look dumb in relation to your peers, because your peers might be outperforming you simply because there's more hype going into the stocks that they own. But when they get flushed out, when they get smoked because growth slows down, or because the Federal Reserve is scaring people that it will raise interest rates, those growth stocks are going to get smoked. People always will start thinking about, what is it that I have on my own portfolio? That's when value investing comes into vogue. Then value investing does well for a few years. Then people forget about fundamentals. They forget about the fact that whatever is behind the ticker symbol is a real business. Instead, they focus on the price versus two information, price and value. And value investing goes out of vogue again, and growth investing becomes fashionable again, until those people get burned and we go through these cycles over and over and over. In summary, I don't think value investing will ever go out of style. It will never be dead, purely because it's based on the fundamentals of there's a ticker symbol and there's a business behind it. The better the business does, the more valuable it will become, and over long periods of time, that value will be reflected in the stock price. With that being said, thanks for watching this video. Hope you enjoyed it. Click the like button, comment, subscribe to this channel to help it grow, and I will see you in the next video.